Hi there. Tell me, what are you going to do if Alibaba goes to $50? From $72 goes down to $50. Will you keep buying the stock or you give up? You see, everybody knows that Alibaba now is quite undervalued. Way undervalued. But the problem is, this is not about how cheap Alibaba is, but it's about psychology. If you can handle long periods of low prices, I mean the stock price to do nothing for the next 3 years, and then to rebound like this, a return over 300%. But my question for you is, can you handle this? And what are you going to do if the stock price keeps going down even more? Let's say to $50. The market cap will go down from 185 billion to of about 100 billion. Will you keep buying more? This is the question you should ask yourself. Because if you can handle this high volatility, I mean another decline in the stock price of maybe 50%, then you are not ready to invest in Alibaba. And it's better to avoid this stock. But if you like this company, its future, its opportunities, then it will be quite bad not to invest in Alibaba. And if also the stock price goes down even more to $50. By the way, in the past, the stock price was about $63. So this may happen again. You may see not decline the stock price. It might go to $60 or less, $50. Now, what will happen if Alibaba goes to $50? That means the market cap will be around 100 billion. And the P ratio may be around 6, something like that. Now, if you look at their balance sheet and you add all their cash plus their investments, so the cash on hand 43 billion plus short-term investments 40 billion, and you also add their securities because Alibaba is invested in other Chinese companies, and you add them all, 4 billion, 43 billion plus other investments, 28 billion. So the total cash plus their investments is around 141 billion. And compare this to their current market cap of 185 billion, you might say that Alibaba is traded over around their cash on hand. Of course, it's a little bit higher with 45 billion. Now, if the stock price goes to $50 and the market cap is around 100 billion, that means Alibaba will be traded below the cash on hand. That can happen. It's not a big deal. There are other Chinese companies that are traded below the cash on hand. Of course, Alibaba also has some debt. Their current debt and the long-term debt is about 22.8 billion. So if you subtract their debt from their cash, the total cash, their net cash will be around, their net cash plus their investments is around 118 billion. So this is what you get only for their cash plus their investments. Now, don't forget that Alibaba is a profitable business. As you can see, the price to earnings is around 10. And they keep growing, by the way. So if you look at their free cash flow for the last 6 months, it was around 11 billion. You can assume that for the entire year, they might make more than 20 billion free cash flow. If you add 20 billion free cash flow plus the net cash, and by the way, you also apply a multiple to their free cash flow, let's say 10, that is around 200 billion. Plus the net cash position, 118 billion, that is over 300 billion. Of course, if the multiple of their free cash flow goes higher, let's say to 20, then the value will be higher, over around 600 billion. But anyway, we all know this. that Alibaba is quite undervalued compared to their fundamentals. But the problem is, and what people can handle, is this volatility. And of course, you also need patience. You have the patience to wait for the next 3 to 5 years so that the stock price can rebound. Imagine, maybe you invested when the stock price was around $65 in 2022. And so far your return is around 4%. I mean, your upside only 4%. You might say this is a bad performance compared to the S&P 500. So when you see this return of 4%, your upside only 4%, and compare it to the S&P 500, you might say that this is quite bad. I'm not such a good investor. But what people forget is the long-term goal. I mean, if you are willing to wait for the next 3 to 5 years, then your return may be even higher than the S&P 500. Of course, there is also risk with Alibaba, because as you know, this is a Chinese company. Many bad things can happen, as there is this trade war between the US and China. But compared to their fundamentals, as you can see, Alibaba is a great opportunity at the current price. Of course, many bad things can happen in the future, but at the current price, your upside can be quite huge. And the risk may not be that high, quite low at the current price. But as I asked at the beginning, what are you going to do if the stock price goes to $50? If your answer is, I'll buy more or I don't sell, then you are ready to invest in Alibaba. But if you get scared because of China or other bad news, then don't invest in this company, because you might lose your money. I mean, not all your money, but a big part of it. And you don't want that. You want only profits, high returns. So the stock price of Alibaba may go down to $50. That can happen. Imagine, if interest rates stay high, around 5% at the current level, for a longer period, even though they announced that they are ready to lower the rates, those high rates may lead to a crisis, a crash in the US economy. And when the S&P 500 goes down, you may have a decline like this, as it happened in 2020, then all stocks around the world will go down during that period, that short period. And then it might go up. Or not. Maybe the crash will be for a longer period. But anyway, you have to know that if the US goes down, all the stocks around the world will go down, and also Alibaba. Therefore, the stock price may go to $50 or even less. Many things can happen. That's why you have to be prepared for any situation. Another decline in the stock price of 50%, or to be ready for a huge rebound in the stock price of Alibaba. A double this year. This can also happen. But, as I said, be ready for the worst. And if you can handle those low prices, bad news, low valuations for a longer period, for about 3 to 5 years or even more, then you are ready to invest in Alibaba and you don't worry about bad news or other things. You are ready to compound your money over time. Now, if you are scared of Alibaba, then you can invest in the S&P 500. And your return may be 10% a year, 20%, it depends on what price you pay. For instance, over the last 2 years, the return from the S&P 500 was around 1%. That's why it's quite important what price you pay. Because if you invest when the valuations are high, your return won't be that great. But if you buy when prices are low, your return can be quite high, 40% a year. So it's all about the price you pay, when you buy and when you sell. You can make money with any stock. You can buy Microsoft, you can buy Tencent, or Apple, as it went down now. If you buy the right price, your return can be quite high, over 50% in the case of Microsoft. For Tencent, same thing. If you bought when the stock price was at the lowest level and you sold this year, your return was around 48%. So this is another great example. A Chinese stock which delivered 50% return. So not only the US companies can deliver high returns, also Chinese companies, if you buy them at the right price. And this can also happen with Alibaba. You buy now at the lowest price, and the stock price can double this year or the next year. This can also happen. That's why you have to be ready for all the scenarios. The most important is the risk, the decline in the stock price. If you can handle a decline of 70%, then you are ready to invest in any stock around the world. So that's it for this video, and if you have other questions, please let me know in the comments.